Today's top three things in my notebook: number one is the U.S. dollar, number two is oil, and number three is the 10-year bond yield. Obviously, the U.S. dollar was being devalued explicitly and implicitly yesterday. So again, at the end of the day, the Federal Reserve was trying to push out the dots, change the language to no patience, but at the same time, they don't want to be impatient, which means the same thing. So at the end of the day, they're targeting interest rates lower. They were targeting the dollar lower. She talked about the dollar, which is, of course, not what Ben Bernanke did. You can go back and review the tapes. He would never mention the dollar and had not mentioned the dollar, certainly not as a leader like she was talking about yesterday. So again, hyper-focused on it because it's a politicized situation. She tried to knock the dollar down, and she did. The question is, can the dollar break the immediate-term trade line? Unlikely. Obviously, the dollar's already bounced this morning versus the euro. So again, I'd stay long dollars, but from a price, we have not issued a buy signal on the immediate term yet, but I might this morning. Point number two, oil. So oil had the little Viagra moment, and how nice was that, Janet, of you at your age to pull that off? But at the end of the day, there it is. The Viagra move it was, if you bought it, within a minute of us basically saying it, it was 2:03 p.m. to be time-stamped on this. It was live video. We said, look, this is dovish. Within a minute of that, if all you did was buy oil and gas stocks and oil, you were up like 3 to 4% within an hour and a half. So that's where the wood went, pardon the pun. But the reality is that she effectively had a Viagra moment. The market woke up this morning in Europe and said, oh, there's still these other dudes out there who can devalue their currency against that move. The euro hit the top end of the risk range, which is 108, 109, and is headed back down to 106. No support for the euro to 104. So what this does is puts in play the currency war. So again, if you want to get U.S. dollar oil right, you have to get the European moves right. You have to get the risk ranges right. So again, this is what's going on. Oil is down and down hard. No support to 41.32, which would be a new closing low if they were able to close it there. And yes, we do remain bearish on commodities and oil in particular. 10-year bond yield, finally, again, just great move for the bond market yesterday. That was the bigger move than anything else. Don't forget that the returns for the TLT are more than 2 times that of the S&P 500 for the year to date, and that's after the S&P 500 had a big move, but bonds did too. The bond move was huge, and again, that puts you back into play on the all-time lows of U.S. Treasury yields. The next catalyst, of course, is what Janet outlined to you, which is the data. She is, quote-unquote, data-dependent, and if the data is deflationary, which it will be, you're going to get the March data, obviously, in April, then the bond market is going to most likely react positively to that, and you're going to have lower yields for longer. And those are your top three things.